The American financial tune is no longer being called in New York, but rather in Tokyo, London, and Frankfurt. That's not some random Twitter hot take. That's the New York Times in the late 80s, as America lost control of its own money game. Remember when your parents told you not to spend more than you earn? America didn't just ignore that advice. It went on a shopping spree so massive that foreign countries had to fund it. By the end of this video, you'll understand how we went from being the world's financial daddy to its dependent child in less than a decade. But before we move forward, I would invite you to like the video and subscribe to the channel. Remember when America was the rich uncle giving out loans to everyone else? Well, that changed faster than hairspray-crusted mullets went out of style in the 80s. In the early part of that decade, the US was sitting pretty as the world's largest investor. Basically, the global economy's sugar daddy, tossing cash around to anyone with a decent business plan and a smile. But boy, oh boy, how things flipped. By 1987, America had maxed out its national credit card to the tune of a record $154 billion current account deficit. For those who slept through Economics 101, that's like spending way more than you earn and then asking your roommates to cover your rent. Not a great look for the supposed financial superpower of the free world. The funny thing is, America was actually selling more stuff to other countries by late 1986. The merchandise trade deficit, all the junk we buy versus what we sell, started looking better, with smarty pants economists like Lyle Gramley predicting a $30 billion drop in the deficit for 1988. Gramley probably felt like the smartest guy in the room at economist parties that year. This improvement in trade actually gave the US economy a nice little boost, like when you find $20 in your winter coat pocket. Real GNP growth jumped to 4.5%, way better than the measly 2.5% from before. Politicians were probably high-fiving each other in Capitol Hill bathrooms over these numbers. But here's where it gets weirder than a cat in a tuxedo. Even as America was selling more stuff abroad, it was borrowing money like a college kid with their first credit card. The math just didn't add up, sorta like Donald Trump's tax returns. Senator D'Amato summed it up perfectly when he said America went from being the world's largest investor to the world's best investment opportunity. It's like going from being the casino owner to the desperate gambler sleeping in your car outside the casino. Not exactly an upgrade in the financial world. The experts couldn't even agree if this was good or bad news. Gramley was all sunshine and rainbows about our prospects, while Robert Brusca from Nikko Securities warned that the deficit would hang around like that one friend who crashes on your couch just for the weekend, but is still there 3 months later eating all your Doritos. So, how exactly did Uncle Sam go from world's biggest moneylender to world's biggest money borrower? It wasn't just one thing, it was a perfect storm of Reagan-era policies that hit America's wallet harder than aerobics hit suburban moms. First, Reagan slashed taxes like Edward Scissorhands on a hedging spree. Great for the rich folks' bank accounts, not so great for government revenue. Then he pumped billions into the military. Gotta keep those Soviets scared, right? And to top it all off, America kept the dollar stronger than Superman, which made foreign goods cheaper than American ones. This meant average Joes were buying Sony Walkmans instead of whatever America was trying to sell, probably something less cool. By 1982, the US had a small $7 billion surplus, but by 1987, we were drowning in a $160 billion merchandise trade deficit. Our net investment position went from positive 4.6% of GNP in 1981 to negative by 1985. By 1987, America had racked up foreign debt of $368 billion. That's 8.1% of GNP, folks. The inflow of foreign cash wasn't all bad news. It helped keep interest rates down, according to Senator D'Amato. This allowed more investment than would have been possible otherwise. But there's always a catch. Like finding out your free trial requires your credit card info. Nigel Galt, some brainiac from Data Resources, predicted the merchandise trade deficit would bottom out around $113 billion in 1989, with the current account deficit hitting approximately $134 billion before getting worse again. Not exactly the forecast you want to hear when planning your economic future. But this borrowing spree wasn't just about boring numbers on spreadsheets that make most people's eyes glaze over faster than a Thanksgiving turkey. It was about who actually controlled America's financial future. Because when you owe someone money, they've got you by the economic short hairs, and that's exactly what happened next. America's financial decisions started being made not in New York, but in Tokyo, London, and Frankfurt. The country that once funded the rebuilding of Europe after World War II was now passing around its national hat asking for spare change. Talk about a plot twist worthy of a soap opera. Imagine waking up and finding out your neighbor now controls your bank account. That would be super weird, right? Well, that's basically what happened to America in the 1980s. The New York Times was telling everyone something that would have sounded completely bonkers just 10 years earlier. The American financial tune is no longer being called in New York, but rather in Tokyo, London, and Frankfurt. This wasn't just some small change like when your favorite fast food joint replaces regular fries with curly ones. Foreign investors weren't just buying a few stocks here and there. They were financing a massive 93% of America's current account deficit through securities purchases in early 1988. That's like having your roommate pay almost your entire rent while you spend your paycheck on video games and pizza. These foreign purchases weren't random either. Bonds were the hot ticket items, making up 3/4 of all foreign investment. Direct ownership of American companies was only about 17%. Robert Brusca, chief economist at Nikko Securities, explained that in 1986 and 1987, stocks made up around 17 to 20% of foreign purchases. But by early 1988, that number dropped to less than 2%. Foreign investors were like, "We don't want to run your companies. We just want to own your debt. Thanks." This created a situation weirder than finding out your cat can speak French. America needed these foreign investors to keep interest rates down, but it also meant those same investors could pull their money and crash the economy faster than a toddler knocks over a block tower. It was like being handcuffed to someone who might decide to jump off a cliff at any moment. The Japanese were especially big players in this game. They were buying everything from treasury bonds to fancy Manhattan real estate like they had just won the lottery. In the first 4 months of 1988 alone, Japanese investors bought $13 billion in treasury notes and bonds. That was 43% of all foreign purchases. Another $4.1 billion came from the United Kingdom and $1.2 billion from Luxembourg, but Brusca pointed out that many of these were probably Japanese investors working through offshore accounts. They were sneaky like that. Tracking who owned what was harder than finding your keys in a darkroom. Brusca explained that because foreign investors often had offices in multiple places, it was super hard to know where the money was really coming from. Purchases made through foreign offices in the US weren't counted as foreign, and investments through places like Luxembourg and Switzerland looked like they came from those countries, not their real owners. It was financial hide-and-seek on a global scale. Meanwhile, experts like Nigel Galt from Data Resources were making gloomy predictions that things would get even worse after 1989. They expected the current account deficit to bottom out around $134 billion before growing again. That's like your doctor telling you your diet is working great, but you're still going to gain weight next year. Not exactly encouraging news. This foreign dependency created a major policy headache, like the kind you get from eating ice cream too fast, but worse. If America raised interest rates to fight inflation, it might attract more foreign money but slow down the economy. If it let the dollar fall to boost exports, foreign investors might run away faster than teenagers when parents come home early from vacation. So who really controlled America's financial markets by the late 80s? It wasn't the Wall Street guys in their fancy suits. It was foreign investors who could tank the economy by pulling their money out. This gave countries like Japan and Germany unprecedented power over U.S. economic policy. America was basically that friend who's always borrowing money and can't say no when the lender asks for favors. The real question was, could America handle this financial balancing act? Walking this economic tightrope was tricky enough during good times, but what would happen when a global crisis hit? It's like learning to juggle while standing on a boat. Everything's fine until the waves start getting bigger. This financial dependency was about to face its biggest test as storm clouds gathered on the global economic horizon. America had gone from being the rich guy giving out loans to the one desperately trying to make minimum payments on its credit cards. And in the financial world, the person who owes the money isn't the one calling the shots. It's the one collecting the debts who holds all the power. So that's the story of America's $514 billion borrowing party. Uncle Sam went from being the rich dude handing out cash to the broke friend asking for money faster than you can say economic decline. One day we're funding the world. Next day, Japan and Germany are checking our credit score. This 80s financial mess still affects us today, with China now playing the role Japan once did. They own our debt. We buy their stuff, and the cycle continues. So next time someone brags about American financial independence, just laugh. Because like any college kid with maxed out credit cards knows, whoever holds your debt holds your future. That's all for today. Make sure you like the video and subscribe to the channel.